For 2 decades, Vladimir Putin built a fortress, not of concrete, of gold, locked deep inside state vaults, a $300 billion shield against sanctions, isolation, and war. But the vault doors are opening. In just 6 months, Russia has sold off gold at a pace not seen in 25 years. Not during COVID, not during the 2014 sanctions, now. So what does the Kremlin know that the rest of us don't? And what happens when the gold runs out? Welcome back to Currency Arc Insight, the channel where we track the decisions nations make when their currencies, reserves, and economic sovereignty are on the line. Today, we're examining a shift few Western analysts are covering in depth. Russia's accelerating liquidation of its sovereign gold reserves and what it signals about the true cost of a prolonged war economy. To understand why Russia is now selling its gold at the fastest pace in a generation, it is necessary to understand why Russia built that gold reserve in the first place. The story begins not in 2022, but 2 decades earlier. Starting in 2002, the Bank of Russia embarked on one of the most aggressive sovereign gold accumulation campaigns of the modern era. Year after year, the Kremlin added hundreds of tons of physical bullion to its reserves, steadily building what foreign analysts would later nickname Fortress Russia. This was not a passive investment strategy. It was a deliberate act of financial engineering, designed around a single powerful principle. Gold, held on domestic soil, cannot be frozen, seized, or blocked by any foreign government or institution. That principle mattered because Russia's economic planners understood something many nations overlook. Foreign currency reserves, no matter how large, exist as entries on ledgers controlled by other countries' banking systems. Dollars held in Western institutions can be frozen with a signature. Access to SWIFT, the global financial messaging network that underpins most international transactions, can be revoked at the discretion of Western governments and their allies. Bonds, securities, and foreign bank deposits are all, at their core, promises made by someone else, promises that can be broken. Gold is different. Physical bullion, stored inside a nation's own vaults, answers to no foreign jurisdiction. It cannot be frozen by the US Treasury. It cannot be blocked through SWIFT. It cannot be seized by a court order in London or Brussels. This is precisely why central banks, not just Russia's, have historically treated gold as the ultimate reserve asset, a form of wealth that sits fundamentally outside the reach of any single government's political leverage. By the time Russia annexed Crimea in 2014 and faced its first major wave of Western sanctions, this strategy had already been in motion for over a decade. The gold reserves continued to grow. And when Russia launched its full-scale invasion of Ukraine in February 2022, the logic behind Fortress Russia was tested in the most direct way possible. Western nations responded to the invasion by freezing an estimated $300 billion in Russian foreign currency assets, effectively locking Moscow out of a significant portion of its international reserves overnight. It was, by any measure, an extraordinary demonstration of financial power, and it validated everything the architects of Fortress Russia had prepared for. The frozen assets were foreign-held. The gold was not. While hundreds of billions in reserves became inaccessible almost instantly, Russia's physical gold, sitting inside vaults in Moscow and St. Petersburg, remained entirely under Kremlin control. For a brief period, this appeared to confirm the wisdom of the entire strategy. Gold had done exactly what it was designed to do. It had provided Russia with a financial shield immune to the sanctions weapon that the West had spent decades refining. In theory, this reserve was meant to be held, not spent, a strategic buffer preserved for true national emergencies, rather than routine budget management. That is what makes the current moment so significant. More than 4 years into the war, that same reserve, the one built specifically to withstand prolonged economic isolation, is now being liquidated at a pace unlike anything seen in the past 25 years. The fortress built to protect Russia through this exact scenario is the fortress now being dismantled to fund it. This is the central tension worth understanding before looking at the numbers themselves. Gold reserves of this kind are not built for convenience. They are built as a last line of defense, a resource meant to be preserved until circumstances leave no alternative. When a sovereign nation begins drawing down that reserve at record speed, it is rarely a sign of strength or flexibility. It is typically a signal that other, less costly options have already been exhausted. In the next part, the actual scale of this liquidation will be examined in detail, including exactly how much gold has been sold, over what period, and how this sell-off compares to previous crises, including the global shutdown during COVID-19. Understanding the scale of Russia's current gold liquidation requires context, because a headline figure on its own can be misleading. It is not simply that Russia is selling gold. Central banks sell and buy gold regularly as part of normal reserve management. What makes this moment different is the speed and the concentration of the selling and how it compares to previous periods of genuine financial stress. According to data confirmed by the World Gold Council, the Bank of Russia has sold approximately 43.5 metric tons of gold from its sovereign reserves over a 6-month period. To put that figure into perspective, it helps to look back at the last time Russia was forced into significant reserve liquidation, the early stages of the COVID-19 pandemic in 2020. During that period, global markets froze, oil prices briefly went negative, and government revenues collapsed almost overnight across the world. Central banks everywhere, including Russia's, were forced to liquidate reserve assets to cover emergency spending. Yet even during that extraordinary shock, Russia sold less than 1/6 of the gold it has liquidated in the current 6-month period. In other words, the current pace of selling exceeds even the depths of a once-in-a-century global pandemic shutdown. Breaking the timeline down month by month makes the pattern even clearer. Between January and February, Russia liquidated roughly 15 tons of gold. Through the spring months, the selling continued at a steady monthly pace, rather than tapering off as a one-time adjustment might. Then, in June alone, Russia sold 9.33 metric tons in a single month, one of the largest monthly drawdowns in the entire sequence. Across the full 6-month window, these sales generated an estimated $5.6 billion for the Russian state. On the surface, that may not sound like an overwhelming figure, particularly for an economy the size of Russia's. But the significance is not in the dollar amount itself. It is in what that money is being used for, and what kind of asset is being sacrificed to obtain it. This is not foreign currency being spent. It is not short-term bond issuance or new borrowing. This is Russia converting one of its most strategically protected, sanction-proof assets directly into operating cash. Gold that was accumulated over 2 decades, specifically to remain untouchable by foreign governments, is instead being sold to domestic, state-backed Russian banks on the over-the-counter market. Those banks then hold or trade the metal, while the central bank extracts the cash needed to help fund government obligations, including defense spending. This detail matters because it reveals the underlying purpose of the sales. Central banks do not typically liquidate strategic reserves at this pace to make minor budgetary adjustments. Reserve assets of this kind function as a financial buffer, held specifically so that governments are not forced into difficult decisions during periods of stability. Drawing down that buffer at record speed indicates that the buffer is actively being relied upon, not preserved for a future emergency, but consumed to manage a present one. There is one additional factor that makes the timing of these sales notable. Gold prices have surged to historic highs over the same period, at one point approaching $1,600 quoted US dollars per troy ounce. From a purely financial standpoint, this means Russia is liquidating its reserves near the top of the market, extracting the maximum possible value from every gram sold. In that narrow sense, the timing reflects a degree of financial discipline rather than panic selling at a loss. But that discipline does not change the underlying signal. A government does not need to sell a sanction-proof strategic reserve at record pace simply because prices happen to be favorable. It sells that reserve because it needs the cash, and gold, even near all-time highs, has become the most readily available source of liquidity left. The question that follows, naturally, is why? Why has Russia's government reached a point where 6 consecutive months of record gold liquidation has become necessary? That answer lies in the growing gap between what the war is costing Moscow and what its traditional revenue sources, primarily oil and gas, are still able to provide. That widening gap is the subject of the next part. Every liquidation of a strategic reserve traces back to a simple question. What is the money actually needed for? In Russia's case, the answer lies in a budget gap that has widened to a scale not seen since the collapse of the Soviet Union, driven by a collision of rising costs and falling revenue happening at the same time. On the spending side, Russia's state budget is currently running a deficit of roughly 6 trillion rubles, equivalent to approximately 76 billion US dollars. For context relative to the size of Russia's economy, which is often compared to that of Italy, this is not a minor shortfall. It represents a structural gap between what the government is spending and what it is bringing in, a gap large enough that it cannot be closed through ordinary fiscal adjustments alone. The primary driver of that spending is military expenditure, which has climbed to levels not seen in Russia since the fall of the Soviet Union. More than 4 years into the war, the costs have only compounded. Weapons manufacturing, soldier salaries, casualty compensation, and continuous drone procurement are consuming an enormous share of state resources. These are not one-time costs. They are recurring monthly obligations that scale with the intensity and duration of the conflict. And with limited territorial progress on key fronts, particularly in eastern Ukraine, there's little indication that this spending will ease in the near term. At the same time that military costs are climbing, Russia's traditional economic engine, oil and gas exports, is under mounting pressure from multiple directions at once. Tighter Western enforcement against Russia's so-called shadow tanker fleet, the network of vessels used to move Russian oil around price caps and sanctions, has reduced the export margins Russia is able to capture on each barrel sold. Global price caps and broader softness in energy prices have further eaten into revenue that Moscow had relied on to help fund the war. Compounding this pressure is a more direct and increasingly effective form of economic disruption. Sustained Ukrainian strikes against Russian oil refineries, fuel depots, and transport and logistics infrastructure. These are not isolated incidents. They represent a systematic campaign that has choked domestic fuel production and export capacity from within Russian territory itself. The result is a double pressure point: export revenue constrained from the outside through sanctions enforcement, and production capacity constrained from within through direct strikes on infrastructure. Under Russian law, when oil and gas receipts fall below the government's baseline fiscal targets, the central bank is required to sell reserve assets to cover the shortfall. For the first 2 years of the war, Moscow primarily met this requirement by selling foreign currency reserves. That approach, however, has led directly to the next constraint now shaping Russian policy, one that will be examined in detail in the following part. The increasingly limited pool of foreign currency Russia can safely draw down without threatening its remaining access to international trade. Taken together, these pressures explain why gold has entered the picture as the preferred remaining asset to liquidate. The deficit is not shrinking. Military spending shows no sign of easing while the war continues. Energy revenue, the traditional backbone of the Russian state budget, is being squeezed from both sanctions enforcement and direct battlefield disruption. When the primary revenue source weakens at the same moment that primary spending accelerates, a government is left with a narrowing set of options to bridge the gap. This is the environment in which record gold sales have become not a strategic choice, but an operational necessity. The reserve built over 2 decades to withstand exactly this kind of prolonged pressure is now the mechanism being used to survive it in real time. The next part examines why Russia is turning specifically to gold rather than continuing to rely on foreign currency reserves, and what that shift reveals about a deeper vulnerability in Moscow's remaining financial options, its dependence on the Chinese yuan. To understand why gold has become Russia's preferred asset to liquidate, it is necessary to look at what happened to Russia's other major reserve asset over the past several years, and why that asset is no longer a safe option to keep drawing down. When Western nations cut Russia off from the dollar and the euro following the 2022 invasion, Moscow needed an alternative currency to conduct international trade, particularly with its largest remaining economic partner. The Chinese yuan filled that role. In the years since, the yuan has become Russia's primary liquid foreign reserve asset, the currency used to settle trade, pay for imports, and maintain financial ties to markets still open to Russian business. This is precisely what makes the yuan such a delicate resource for Moscow to manage. Unlike gold, which sits physically inside Russian borders and can be sold at will without external dependency, the yuan represents Russia's functional bridge to the one major economic relationship it has left. China is not simply a trading partner for Russia at this stage of the war. It is, in many respects, Russia's primary remaining connection to the global economy. Economists tracking Russia's reserve management have noted that the central bank is notably reluctant to continue drawing down its yuan holdings at the same pace it once did. The reasoning is straightforward. If Russia depletes its yuan reserve significantly, it does not simply lose a currency balance. It loses liquidity in the one channel, still allowing it to conduct meaningful international trade. Rebuilding that position would not be simple. And in the meantime, Russia's ability to purchase imports, settle obligations, and maintain economic ties to Asia would be directly compromised. This is the trap. Russia cannot continue selling yuan reserves without risking damage to its last major functioning trade relationship. Yet the budget deficit, driven by military spending and declining energy revenue, has not gone away. Something still has to be sold to bridge that gap. With foreign currency reserves increasingly protected out of necessity, attention shifts to the other major reserve assets still available: gold. Gold offers 2 distinct advantages in this specific situation, both of which explain why it has become the default choice. First, unlike the yuan, gold carries no counterparty dependency. It does not require maintaining goodwill with another nation, and it does not risk damaging a critical trade relationship when sold. Russia can liquidate gold entirely on its own terms, without needing to consider how the sale affects its standing with any external partner. Second, the timing happens to align with historically favorable pricing. Gold prices have climbed to record highs, at one point approaching $5,600 per troy ounce. Selling into that kind of price environment allows Russia to extract the maximum possible value from each ton liquidated, effectively softening the financial impact of the sale itself. It is worth noting that even the mechanics of these gold sales reflect an attempt to preserve some degree of financial control. Rather than exporting bullion abroad, which would expose the transactions to greater scrutiny and potential disruption, the central bank is selling gold domestically to state-backed Russian banks through the over-the-counter market. Those banks then hold or trade the metal within Russia's own financial system, while the central bank captures the cash needed to fund government spending. The gold, in most cases, never actually leaves the country. Only its ownership shifts, from the central bank's strategic reserve to the domestic banking sector. This arrangement allows Russia to generate the liquidity it needs while keeping the physical asset within its own borders and outside the reach of any external actor. In that narrow sense, it represents a carefully constructed workaround rather than a chaotic fire sale. But the underlying constraint remains unchanged. Russia has effectively narrowed its own options down to one primary lever it can pull without external risk, and that lever is gold. The yuan is too strategically important to keep depleting. Foreign currencies frozen by the West are inaccessible. That leaves gold as the last major reserve asset Russia can liquidate freely, and it is precisely why the drawdown has accelerated to its current pace. The final part of this analysis turns to the question this raises for the future: how much longer this strategy can continue, what it reveals about the underlying health of Russia's war economy, and what lessons investors, sovereign or individual, should take from watching a nation liquidate its ultimate store of wealth under pressure. After examining the scale of the sell-off, the budget pressures driving it, and the constraints that have pushed gold to the center of Russia's reserve strategy, the natural question becomes, is this the beginning of a genuine financial collapse, or simply the cost of sustaining a prolonged war? The honest answer is more nuanced than either extreme suggests. Russia is not on the verge of running out of gold. Despite 6 consecutive months of record liquidation, Russia still holds approximately 2,280 metric tons of gold in its sovereign reserves, making it the 5th largest national gold stockpile in the world. On top of that, Russia produces more than 300 tons of gold domestically every year, a figure second only to China. This is not a country with an empty vault. It is a country with a very large vault that has recently begun opening its doors far more often than it used to. That distinction matters. Financial collapse implies an imminent inability to function. What the data actually shows is something different. A nation with substantial resources choosing, out of necessity, to draw down its most protected strategic asset at a pace unmatched in 25 years. Russia is not empty-handed, but it is spending faster than it is replenishing, and that gap is the real story here. The deeper significance lies not in the reserve levels themselves, but in what the selling pattern reveals about the underlying war economy. Every ton of gold liquidated to cover a month of wartime spending is a ton of gold that can no longer serve its original purpose, backing the domestic currency, cushioning against future economic shocks, or funding long-term development once the war eventually ends. Reserves spent today are not available tomorrow, regardless of how large the starting stockpile was. This pattern is compounded by conditions elsewhere in the Russian economy that point in the same direction. Inflation remains persistently elevated. Interest rates are being held near historic highs, specifically to prevent the ruble from sliding further. Tax increases on corporations, and high earners are being rolled out nationwide to help close the same budget gap that gold sales are addressing. None of these are signs of an economy operating from a position of strength. Taken together, they describe a government reaching for every available lever, monetary, fiscal, and now strategic reserves, simply to keep current operations funded. This is the core signal worth taking away. A nation does not liquidate a sanction-proof 2-decade strategic reserve at record pace because it has attractive options remaining. It does so because the alternatives have already been exhausted one by one until gold was what was left. Fortress Russia was built specifically to prevent this exact scenario. The fact that it is now being dismantled, ton by ton, to fund an unending war does not mean collapse is imminent. But it does mean the fortress is no longer being preserved. It is being consumed. The question that remains is one of duration, not survival. If military expenditures continue to outpace oil and gas revenue, and if Ukrainian strikes on refineries and export infrastructure continue to compress Russia's traditional income sources, how many more months of reserve burn can Moscow sustain before deeper structural cracks begin to show, not just in the gold stockpile, but across the broader economy? There is a broader lesson here that extends well beyond Russia's specific circumstances, one worth applying to personal financial decisions as much as sovereign ones. Gold, whether held by a nation or an individual, functions best as a last line of defense, not a routine source of liquidity. The moment a reserve built for genuine emergencies is instead used to cover ordinary operating shortfalls, it signals that other options have already run out. That is rarely a position of strength. For individual investors, the takeaway is straightforward. Maintaining sufficient cash reserves and avoiding decisions that could force a premature liquidation of long-term wealth protection, whether due to over-leveraging, poor planning, or unexpected financial strain, is what separates strategic gold ownership from a forced sale under pressure. Russia's situation is an extreme sovereign-scale example, but the underlying principle applies at every level. Gold should be the asset you never have to sell, not the one you are forced to.